Joining me now, Michael Vogelsang is Cap Trust CIO, and David Ellison is Hennessy Funds Portfolio Manager. It's great to see you both. David, I'll start with you, and you're the one, I believe, warning a little bit about whether these names are investable for the long term here. So what are the caveats?
Well, I think the issue is that, I think everybody's kind of rethinking what the value of these deposits are. Historically, these deposits could be funded below treasuries. Then you turn around and make loans above treasuries, and that was your margin. And that's how these banks grew. Again, the smaller the bank is, the more sensitive they are to the spread. But now I think because of the digitization of the system, which has finally gotten so big that it's made a difference, and you've seen that in these bank runs, there's no way that kind of money would have left the bank if you had to go into the branch. It all left electronically. And so people are looking at price. And frankly, the bank products are not that good, meaning the yields are very low relative to treasuries. And so, I mean, if you have a bank, if you have a checking account, you're earning 10 or 15 or 20 basis points. I mean, it's a joke relative to what you can get. And it's gotten so wide that people are moving away from it. It's like, a $10 cup of coffee at Starbucks. Nobody's going to buy it. And so we're in this situation now where liquidity is being drained out of the system. And the question is, what impact does that have long term? Because if you had to raise the cost of deposits to be competitive, it would severely impact the long-term profitability of the industry.
Absolutely. I know there's a couple names you do like in this environment. We'll come back to that. But Michael, I'll go to you where you're starting to maybe sniff or nibble. I don't know what action you've taken on these regional banks. For those at home who are wondering if they should be doing the same thing, what's the justification and where would you be looking to buy?
Well, it's all about valuation, right? And it depends on your outlook on what the Fed's going to do. If the Fed has done its job, and we think they have, of sort of ring fencing this thing and minimizing and sort of slowing down the contagion, clearly the deposit issue and the issues just raised about more mobility and quicker access to your money and all the rest are real. It's about valuation, and if you think the Fed has done its job, there are some interesting places to invest that don't have some of those same dynamics to the same level.
Such as?
Yeah. Well, for example, OZK, which is an Ozark bank.
Bank of the Ozarks. Big commercial real estate exposure, if I'm not mistaken.
They do. And, again, they're not banks clearly have taken on a higher level of risk here. The point being is that they're simply cheap enough, and there's enough fear and loathing in the market that it's reasonable to think about making some investments in this area. I'm not saying load up your portfolio and sell everything else, sell your Microsoft and your Apple and buy OZK. The point being, valuation plays a role here, and they've been penalized pretty significantly. And you're seeing that in the market the last couple of days as the markets have calmed down and people are feeling a little better about where we stand from a bank run perspective.
Sure. So you mentioned a name like Ozarks. I know, David, you're focused a little bit different. MTB, CFG, NYCB, which, if I'm not mistaken, is the bank that just saw the surge yesterday after taking over Signature. Why these three?
Well, I'm trying to stop losing money. I think you're just trying to buy a traditional franchise that is hopefully going to get through this cycle here. Because remember, the cycle is now, there's a rate cycle, there's a yield curve cycle, and obviously the yield curve has been difficult for the banks. There is a potential credit cycle to come, and then you've got the constant sort of issue of digitization and consolidation. So I think you're trying to stay with the companies that can beat back that and have some chance of gaining market share in this. And that's sort of the New York community. They gain tremendous market share by taking advantage of a beaten up company. And I think these other companies are in a position where they can take share. They don't need failures. They just need to say, look, we're bigger, we're safer, come work for us. And so they acquire people at no cost, in terms they don't have to pay a premium for them. So I think we're in a situation now where there's a lot of uncertainty, which, again, it's a nice trade. I think Michael's right. Some of these stocks are cheap relative to history. Maybe they bounce a little bit more here. But then you're going to be sitting on a Fed decision. You still have the yield curve. You still have credit concerns. You still have loan growth concerns. So there's a lot ahead of us that we have to work through. And I think from a relative point of view, why own financials when the economy's decent and there's so many other options out there to buy?
All right, fair enough. We got to go, Michael.